Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today we'll have a somewhat abbreviated agenda. We'll go through the market update and Joe's going to go through some charts and we'll be out in time for the big Fed announcement today. So we'll talk about that in a little bit. So let's get started. All right. So overall, market conditions in general, everything's still an 8. As you can see here, a lot of 8s across the board. Everything kind of a pan sell off almost outside of like the dollar strength. So, as far as market pulses, we were right above 30. So now we're down below in the 2362 percentile as of yesterday. So now we're technically oversold. So, when we get down below that 30, usually we can get some kind of bounce. Overall conditions for the market are still, long-term bearish, but, we can't see, where things are too oversold and we get bounces and things like that. So let's take a look at the market pulse. So this is bullish bearish. So you can see, back here we got up 88, 87. So right now, we had plateaued here. That was a couple weeks ago, around 70, at a dip, and then we're running up higher. So now we're at 76, well below that 30% threshold. We crossed that on last Thursday, so a couple days after the meeting, and we've had pretty good price action down. So we'll look for another plateau here on the bearish. These are kind of the peaks we've seen, upper 80s. So we're not close to that yet, but we are oversold. As far as the new lows, we've seen the spikes back here, and they really picked up past couple days here. 665, 550, 706. So kind of as we look back, we've seen kind of these extended periods here, and then things pick up and then they get crazy. So we had a nice extended period, and you can see once those lows flatlined here, the market pretty much went up, and then we started getting some more. So we're seeing a lot of volatility here. We had one drop down here, and then it just picked right back up. So volatility is not going anywhere, especially with what the Fed's doing here, and that just kind of shows it. So we did just start earnings season, is just about to start. So we do sometimes see, beginning of these, like back here in March, we have a big run up. Obviously that turned over once the results came out. The previous one, the results were pretty good. Obviously earnings drive a lot of the action in the market. So we'll have to wait and see, if we hit like a kind of near-term bottom or not. At least for earnings season, that'll be, I think, the big catalyst of where things are going. But the Fed's not helping much. We got big headwinds overall for the market, with the 10-year, all the interest rates going up, and a stronger dollar. Those are kind of the big ones. So overall, 1s and 8s, I'll pull that up real quick. I'll try to pull it up quick. There we go. All right, so previous highs of around 70 in state 8. We're right about 60 right now, and just kind of on a since I guess about a month now, we've been just trending down. So obviously we'll look for, you can see back here, we start to see plateaus when things get turnover. So we're not quite there yet. Something to keep an eye on. So that's it for market pulse. Let's jump into SPX. So still in state 8, 13 of the 28 days, so almost halfway done. We had good bounce off that resistance there, or the resistance up here that we talked about last week. So, kind of blew through the next level support, which is the entry price. So now we're back down into the next level where we typically see a lot of resistance on the way down. We typically see something like this. Obviously, not quite the preferred model that we see, but now it is down into the first level of typical resistance, and you can see our kind of main point that we look at is at 3,800 for the current range that it's in, 42 to 3,800. So you can see we're starting to see some kind of resistance here. Someone make a noise. Yeah, so we're seeing some kind of resistance here. So just keep an eye on that. We haven't really got too close to that 3,800. So we're still smack in that range of 42, and that's pretty much, right here, 42. So that's right above the stops, all the way down to the middle of target 1 and 2. So that's the current range that we have, and it's pretty much bouncing around there. The keys to watch, are these levels right here going to be good support for the market, or we're going to blow through? Obviously, there's going to be some kind of reaction today as far as the Fed, and I think the follow through in the next few days will be more telling than what we see right after the Fed. It's kind of like a knee jerk. People usually go bullish, but for some reason, but after that they're like, oh wait, this isn't good. So still kind of the same range here that we talked about last week, the 38 in here, and then we're well away from the top side there. So let's take a look at the chart. The charts, excuse me. All right, so where were we last week? Right around here. So we'd already dropped below. We're below both the 200 and the 50, pretty far from both right now. So those are nothing real short term that we can look at. As that SMA comes down, it's getting down near our kind of key range there of 42, and it's just kind of trending. So this is our current range. Last week we kind of pulled this out. Wanted to show you those, I think even more important, those trend lines. So I'll pull those up again. So this is the downtrend line here. Helped us with that top back here. As we got right on that, we picked it up. And as Dave showed you last week, I think we were looking at this, this kind of, let me redraw that on the bottom here. We had kind of talked about this range last week, so that has broken down from last week. That shorter term one, obviously the big one, the downtrend is still intact here. So obviously not a bullish sign. We had talked about things kind of narrowing, and it broke below that near term support trend line. So we can pretty much write that one off at this point. And
hey, Josh.
Yep.
Hate to interrupt. Just one quick thing. We did break that trend line, but you can see that crystal, fairly crystal clear 1, 2, 3, 4, 5. Okay, so potentially, this low is the end of a short-term fifth wave down coming out of that mid-August high. And what you have, in the August period, that first leg down, you get the leg up, which would be the two leg, but then that where you had about what, 5 or 6 almost consecutive down days, that leg 3 is longer than the other 2 legs. So, and that's how it's supposed to go. So, yeah, we broke the trend line, but potentially, maybe we're finishing up a 5-wave down. So just
All right. So this is like,
a little different perspective.
yeah, no, it's good. So then we got, so that's 1, that's 2.
Nope.
Right.
I'm in August.
Oh,
Just real short term.
okay. I was looking longer term.
If you go back to the December highs, the problem there is that the August highs, where I think this short-term 5-wave started at the downside, exceeded, levels that it shouldn't have, going back to the February period. So I can't count a 5-wave going back to the, to the highs in January, but in the short term here, it looks like, we do have a 5-wave. Whether you get an extension, as Dave talks about from time to time, that 5th leg can extend. But
Right.
for the time being, we got a short-term 5-wave. So we'll see if it holds.
Yeah, what I was looking at just kind of pop. I don't do a lot of wave. I was just thinking this is 1, 2,
Yep,
3, and then 4, and then
you
this,
got it.
we're in
But
5.
4 exceeded the low in 1. And
Okay.
technically, that's not supposed to happen.
Right. Right in there.
Yep.
Okay. Okay.
But it is, it's an art, as we
Yeah.
all know.
Oh yeah, definitely. So, okay. So that's it for.
Sorry to throw you off there, but yeah.
No. I enjoy people interrupting, so feel free at any point. Yeah, so that was it on SPX. Obviously, still that major downtrend intact. See if we find support. Down in looks like we're seeing some support down here. Where we're currently at. So obviously, if we break these lows, it's going to get ugly, my opinion. But we're not there yet, and we'll see what the Fed says. We'll talk kind of fundamentals at the end of the chart talk here. So similar pattern, for SPX and Russell. Russell's back at the original here entry point. So you can see we had resistance here. And we're running into it again here, so that may be a sign. Near-term support right around that 1800 level. So, the range here is 1917. So still smack dab right in the middle of it, and showing pretty good support here. So obviously, if we break below this kind of level, and the current low for this 1773. So we get down there, we can, if we can break through there, we'd expect to run down here at the target 1, target 2, which is right at 17. So big level resistance. So the same thing with SPX. We get break below here, then I'd expect it to make a run at the average move. Since this is already on that T1, T2 level. So that's kind of where those are, on kind of, acting like support right now. Excuse me, we're up today also. So just, kind of watch that 1800 level for support for state modeling. And then, chart wise, we had 19 and 17. Similar story here. The 200 well above where we're at, even the 1900s well above that. So, but the 50 days in that range, so it's like 1860. So that'd be near term resistance, if we do pop up there. But otherwise, kind of watch that 1800 near term. And I don't know too many people that are playing this market currently. just with what the Fed's doing and, the Fed announcement today. So we'll start talking about that now. So current target for the meeting 75. I think that's pretty much baked in. They've been pretty good at letting out, if they're going to do something other than the consensus. So, consensus right now is 82% that we're going to 75-point hike. Anything higher, I think would be obviously, bearish for the market overall. That's kind of where we're at. The next meeting is in November, so we got some time till the next one. I think their terminal rate that they had talked about, will be at 3%, if they do 75. So their terminal rate, they're talking 4 for overnight lending. So, that'll definitely put a hurt on a lot of things overall. Rate wise, you can see here still inverted. The 10 to the 2, about where we saw it the other day. When we looked at those charts, almost, a little over, 0.4 between this 401 and then a 3583. So, we showed that chart, quite a while ago, this to the 10s chart. So, we're still down here and lower than actually when I showed it before. So the last couple times it's breached, of any significance was back here in 2000 and 2006. So we did see one back here, and this was back when they were raising rates and basically doing the quantitative tightening, which is the perfect lead in to the next little chart we talk about. So quantitative tightening, I thought I had it pulled up. We'll pull it up real quick. To everyone's surprise, I'm sure that's been on these calls, we actually went up in assets last week. So, the reading will come out. I think it's either tonight or tomorrow. But so far for, September, we've actually increased from where they were at the end of August. So this was supposed to be the start of the big runoff, and it's quite contrary. We've actually added assets. So maybe next week's going to be a big, this next week and a half, they're going to get rid of a lot of assets. But so far, not so much. Been a big whimper as far as, and I think that starting to really hurt their credibility, when they're saying they're going to do stuff and not really doing anything about it. I mean, you look big term, long term, it's a, down like I think I went to the stats last week. We were down like 1.5% of the peak, and back here when we got into trouble, that was like a 15% drop. So we haven't even really started QT yet, in my opinion. We've stopped adding, and I think they're kind of assessing, okay, trying to figure out how to do this. They haven't been adding, so that's really hurt the market. But, when they actually start pulling stuff, that's going to mess with the liquidity, in my opinion. So,
say, Josh,
Yeah.
this is Dave. Can I do a quick interrupt while you're right here? I have a question for you. I just don't know. Is there a time element to bond expirations? Like we have quarterly, monthly, weekly options expirations. Is there how do bonds mature at what rate? Are they at the end of the month or middle of the month? Does anybody know? Do you know? I don't know.
Oh, as far as I'm sure there's set dates, multiple maturities. Obviously they have like short term, all the way up to long term, all these, bills to notes to bonds. I'm not sure what day of the week or day of the month they expire. I expect most of them would, either be the 1st or the 15th But I'm not sure offhand. I wouldn't think there's more than, either first, 15th or the last of the month. Yeah, I don't think it'd be like on the 12th or whatever. So,
But you think it would be more of an even kind of spread out and not like all bunched up, or, we just had triple witching kind of thing for options. I just wondered if there's such a thing for bonds or not. And like I say, I have no clue.
yeah, well, I'm sure there's a standard. I think it's only 3 different possibilities for most of them, either the first, 15th or end. I know most of the coupons come on like the 15th. But yeah, I mean, you can look it up. Obviously I don't know like what day the 3 months expire, 3-month treasuries, but that's what would be my guess, one of those 3 days. So,
Okay, well, thanks.
mhm. So, we did, we do have some popping over 4 here, and, I always bring it up, that one chart. I think it's important. If I don't, it will not save like this after even if I save it, it just goes back to the original, but it's kind of annoying. But you can see here, like 4, I'll do a straight line. Let me see. That's like 4. Well, that's a little before 4, but you can see, after 4, things are really starting to turn off. And, after 5, everything's pretty much negative correlation. So that means rates are going up and stocks are going down. So that's why I think after 4, things, really start to turn. So just be very careful. Just talking about that. I mean, Joe and I were talking the other day. Like, where do people normally hide? In this kind of environment. So, it's looking at a few different things. All right. So one is floating rate. So these things are supposed to be like, short maturity, like a few months, and they like reset every few months. So this one, floating rate, I mean, the rate's like, pretty much trash, 0.64. So I'm not sure, and all of them are like this, all these floating rates are all like really bad yields when, I mean, you can go out and get a 1 month for 246, like a CD pretty much, will pay you that, 3 months, 3.3. So I'm not, and I just bring this up as a question because I don't understand it. Like these yields should be resetting. Anyone that's familiar with these floating rates, like normally they're short term, and maybe they just bought a lot of long term. I don't know, and they're stuck in them. But if they were stuck in them, then like the price would drop significantly. Because their duration, and they got a 3-year bond at 1%, and now the 3 years at like 4, then the price would go drastically down because no one would want it. So I was just trying to figure it out. And you guys can obviously comment. The other thing, or like gold. Obviously, up from 18, but since the beginning of the year, pretty much down. This is usually like an inflation safe haven type thing. And the other one would be tips. So these are inflation protection bonds. I mean, the rates are good. You can see them start to pop up 695, but you can see the price. I mean, if you're in these, beginning of the year, and you're down, what is that, 116? You're taking a huge hit, and you're still underwater. So I mean, there's like almost no place to hide at this point, which is kind of scary. Outside of the one, say one of the big winners has been the dollar, and this is pretty much, I think, impacting gold and silver. It's also impacting equity prices. The stronger the dollar, the more we're hurt overseas. So, I mean, if you pull this way back, I mean, we're at pretty much all-time highs, at least since it's been tracking. As soon as we broke above this kind of 27, it just really just shot up. So when this ends, I'm not sure. We talk about this a lot. Europe's in huge trouble. So this dollar, um, it's a relative measure against like the euro. So this is you can pull up these different charts. The euro used to be around one and a quarter, at least for quite a while. 1.2. Now it's underwater, so it's below parity. So it's a relative measure of that. Also, same thing with sorry, someone's talking. Same thing with the pound from Great Britain. Same thing. I mean, you just look at the front here. Everything's an 8 except for the dollar. So it's a relative measure, at least of all these currencies. Same thing with the yen from Japan. I mean, look at that thing. That's just like a rocket ship since basically the beginning of the year. And these things normally, are moving like this, like not much. So this has been a huge headwind, the dollar. That's the only thing I can, surmise from all this. So you got the dollar stronger, and then you got the yields going higher. So both big headwinds for the market. I mean, people are going to start to see. Oops, sorry. Okay, I can get 6 months. I can get 4%. I'm okay with capital preservation for right now. I mean, you'll still be losing to inflation, but you're not getting double whammied. As far as I think there's going to be a trade-off at some point where people are just start bailing on the market just as they keep driving demand into the toilet. So when they pivot, no idea. I think we're ways off from that. The inflation readings are still well above anything tolerable. 8 something. I did want to pull out this yesterday. I saw this. This is Germany. So this is pretty much the strongest country in Europe. PPI year over year, 45.8%. That's producer price index. So their costs have gone up almost 50% in a year, in a month, almost 8%. I mean, that's insane. And I think it's going to get worse, with gas, shortage going on there. So, and we've talked about that a bunch. So, I mean, Europe is, I think, in big trouble, and then it's going to spill over here. We're very tied with Europe. So, these global economies, just think, I mean, how many German, products do we have? All the cars, are we going to be able to get car parts for, Joe's Mercedes? Is he going to get parts for it? Like, just something to think about. As they, see article after article about things, shutting down over there because they can't afford, the power prices. So I'd watch Europe. That'd be, I think that'll be the first one to really get in trouble. And, we're just starting to get, into, not even winter yet, but, temperatures will start turning here soon. And I think it's going to get real ugly in Europe. Okay, I think that was all I had. Only 31 minutes. Okay, I'll open up to questions, comments. Anybody?
Yeah, Josh, this is Dave. I always have a comment. So first of all, I like to thank you for the progression that you've been going through for a number of weeks now. It's absolutely great for me to watch this. I mean, anyway, I appreciate all the work you've done with all of the things that we look at or that we've been looking at lately. Good job there.
Oh,
Um,
thanks.
and I usually have some idea of where I think things are going in the near term. And I tell you right now, I am clueless. We're still in the middle of about 3 volatility events that I've been watching. And I think, the Fed would shock everybody if they don't move 75 bips today. So, I think that's a done deal. And that's a big nothing burger all the way to November now. What are
Right.
people going to think? The Fed's not going to say anything about, oh, we're going to pivot on such and such a metric, or they're not going to say anything like that. So,
Right.
we won't have any good info from the Fed for, like you say, 6 weeks, a longer period. So what's going to happen then? Well, what do we have? We have earnings, right? Earnings season is coming up. So although I don't have a direction idea of any sort, the things that I'm looking at are expectations from earnings calls. Are companies going to reduce their guidance? And with all these headwinds, if they don't reduce guidance, I think they're crazy, because now's the perfect opportunity. Never look a gift horse in the mouth. So, when you have a recession, if you can't take advantage of a recession by just cooling your heels and saying, well, it's the fault of the recession, we're going to have to pull our guidance in a little bit. That would be the normal thing. If they don't do that, that means they're fighting the Fed. They're going to say, we're going to have we are confident about our pricing power, no matter what you're going to raise the interest rates to. That would be a bad thing for the Fed. I mean, our interest rates, that would be a bad thing for interest, in my opinion, anyway, in my opinion. So that's kind of what I'm watching. And if they do, if most companies and corporations start pulling back their forward pricing and earnings estimates, then all the analysts are going to have to pull their valuations down, because they're based upon growth and guidance. And if guidance is lower, that's just a like say a constant multiplication factor in their formula that's going to have to come down. So if those come down, stocks will come down, prices will come down. So
and we've already seen some bad news, like the FedEx. I'm sure you saw that. And then like Ford just said, their costs have gone up like $1 billion a quarter. Just nothing else changed. It's an extra $1 billion in costs a quarter, based off the current environment. And I think FedEx is the big one, I think.
Yeah. So what do CEOs have to do? Well, CFOs as being a cost advisor for their company would probably say, hey, it's time to be prudent and cautious and not be, growth and don't go risk on growth. So, they'll be telling their CEOs to kind of pull back, hold on to what you can for a while, rather than, try to grow, and I'm guessing. So what do CEOs then? What can they do to maintain the upper and bottom lines? They're going to have to cut costs. And how are they? What the cost cutting method that most CEOs have control over is personnel, right? So if they have to rein in the top, bottom line to match the top line, they're going to layoffs. I see are in the picture, and if we start to have layoffs, then the Fed has got a lose-lose situation. Well, raising interest rates, or if they increase unemployment and don't reduce sticky inflation, because they can't really control the supply side, they have really no choice but to just, we got to stop raising rates, because this is not working on both of our mandates. That's when I see, whenever this pause, you're talking about, and I participate, or I get feedback from another forum, and that's what most of the people there are trying to forecast, is when might the Fed pause, because you can't fight the Fed. So until the Fed pauses, it's hard to be bullish, right? So that's that's what everybody's trying to forecast now. What is your opinion on when the Fed will pause? Nobody knows. They're just starting. So those are the things that I'm looking at, but it's fascinating, but it's just fascinating, but I'm clueless on where things could go until they get there.
Yeah, well, I think, we already have seen layoffs start. So, I mean, that's already started. There's plenty of headlines about, reduction in companies, big companies, but, trying to guess when they're going to pivot. I mean, might will play roulette, and try and guess the number. I think one thing you can really look to are the inflation ratings, that come out. I think that's really what's driving the market now. That and earnings are going to be the big drivers, for foreseeable future here. So, great comments, Dave. Appreciate it as usual. Anyone else got any questions or comments? Yeah, I think, capital preservation is what most people, 401k wise and should be thinking at this point. We're this bearish trend. We got, obviously we're, short term, oversold. So, we could get a bounce, but, we're kind of, going against the flow of the river at that point. The river's pushing down. So, that's why I tell friends, family, I'm like, just think capital preservation right now in general till we figure this out. I mean, if it does bounce and you miss a little rally, I mean, they're going to telegraph that they're going to be, bullish going forward or things like that. I mean, you're not going to miss much, I would think, but, just have some peace of mind and be careful out there. So, all right, we'll turn over to Joe. I think you had some charts you want to run through real quick.
Okay, Josh. Let me share this. Okay. Yeah, and actually, you covered it very well, as you always do. Can you see me all right there?
No.
Not sharing yet. Hold on a minute. There we go. Boom. Okay. So, and I just concur with you and Dave. I think, with the earnings, what the CEOs have to say about, business going forward, I think is going to dictate the direction of the market, over the next couple months. So we shall see in terms of, the retracements that we talked about, big, if we're to make new lows, and we're a hell of a long way away from the June lows in both the Russell and the S&P 500, but round numbers for both of them. If you take, the COVID lows, March of 20 to the November 21 or January 22 highs, basically, for S&P, it's 3,800, 3,500, and 3,200. So round numbers, they're the pullbacks. And, in the S&P, as we've talked about, it was stronger than Russell and NDX. I think we bottomed around 36, never got to a 50% retracement. 50% for SPX is right around 3,500. And then if, the sky completely collapses, 3,200 would be a 5/8 retracement in SPX. Russell, it's 1,900, it's 1,700, and it's 1,500. And our low in Russell was around 1,640. We're well above that now. But round numbers, always, maybe a little easier to keep track of. 3,800, 3,500, and 3,200 in the SPX, and 1,900, 1,700, and just above 1,500 in the Russell from a retracement standpoint. One chart I'll just pull up today, Josh, is VIX. And, what caught my eyes that VIX went into state one, after yesterday's move. And then, it's target one is off, we're at, where are we, VIX, about 27. Heck, target one's up at 32. So if we're to get to these targets in VIX, clearly the market is going to have, some serious issues. I mean, target 3 index is all the way up at 40. So that catches my eye. But then I get down to the chart, and as we've talked about before, and buddy Josh and I are doing a lot of things, behind the scenes, as to try to improve different things. One of the things we want to do eventually is test, all the symbols we track for, state efficiency. So here's VIX, and when I see the ones, I see kind of a top, and when I see 8s, I see more like bottoms. So, and this is over the last year and a half or so, with VIX. So, we'll see whether this state 1 turns out to be a top in the VIX, which would be, a short-term low in the market. Hard to say, but, those last state 1s certainly were much closer to tops in the market, or bottoms in the market than tops. So that, when I saw VIX roll into, the state 1 yesterday, I thought it'd be worth going and taking a look. Dave, I know you keep an eye on this, and the trend line we talked about that we broke, a couple weeks back, but, we'll see if state modeling can be a contrary indicator here for the markets. And, I think it will come back to, what earnings and forward looks are more than anything else. So that's really the only chart I was going to talk about. I'll just pull
Joe?
up again. Yes,
Joe,
Dave.
Joe, before you leave that, sorry, I didn't mean to jump in hard like that, but I want to keep you on that
Go
chart.
for it.
I wondered
for
if you put a regression line around the 1s and another regression lines around the 8s, if that would if that would look like a channel kind of thing. And to me, it looks like, well, VIX is kind of like got a sloping up kind of thing, a gradual uptrend, which is bad. It's not good.
Agreed.
I just wondered about I'm trying to envision what that might look like without actually doing it. And it might not be a channel kind of thing at all, but it might be. It might be too. Just
Starting where? I can do it.
Oh, that's a good question. I would say start right where your cursor was. Yeah.
Oh, yeah, keep sharing, Joe. Joe, I can do it on yours. I can do it on yours. I can annotate on yours.
Okay.
So our regression line is just kind of like the same amount of points above and below the line. So it's kind of like an average kind of thing. The way my mind sees it.
Like that?
Yeah, start there and go to today. And
Well, this one's down here, then you got ones up here. Like these ones up here. Like that? I'm not exactly sure what you're trying.
Yeah, I don't know. Maybe I'll let's take it offline, and maybe I'll talk to Joe and let's see if we can figure out how to do this. I'm not sure how to do it exactly.
I mean, you can obviously
see
once we get up here around 35, kind of like tops, This one has been building that we've been talking about. I mean, we had it here before, but now it's kind of, still building.
There you go.
Yeah, it's a regression. It mean, the retreat to the mean kind of a chart, right? So it might be totally not very I don't know. I think you kind of got what I was thinking about, Joe. And so okay.
Yeah.
It's okay. That's kind of what I was thinking to show. Thanks. Now, I don't know what that means to me, but it doesn't mean terrible, but it doesn't mean great either. It means probably more negative than positive, but
Yeah. Well, I mean, if we break,
we're in the middle of it right now. So it's not near the bottom or the top. So maybe that's a good thing.
Yeah. Well, I mean, if you look down below, like in the history, you have like 2 really big spikes. So, if we break out of here, obviously that's going to be really, really ugly. If we break down below here, then that's going to be very bullish. Anytime we get down here, the flatline stuff here, that's very bullish overall. So, I just kind of, just like everything else, is kind of monitor that range. But I mean, if we have a sustained break above 35, it's going to get real ugly, like these two down here. This one was real ugly. This one was quick, but real ugly. So, hopefully, well, if it does drop, we'll get the quick ugly rather than the multi-year nastiness. So,
Okay, thanks.
Agreed.
yeah.
Something else, just to track, and real quick, so we can get out of here before the Fed, just going back to a couple of sentiment indicators, a little less bearish, I guess, over the last week or so with AAII, but still, somewhat pessimistic. And then I did take a peek at the, because sentiment, is usually a pretty good indicator for, tops and bottoms. And this is the Michigan sentiment indicator that comes out, basically a prelim, in the middle of the month and a final at the end of the month. And just, over the last 10 years, the extremes here are pretty significant. And, just in doing a little homework on this particular set of data, this thing goes back to, I think, 1946. They got a new economist. The person who was doing it before, I think, did it for the last, 46 years or something, is now moving on. But the metrics won't change. And I think they use some of these Michigan sentiment numbers in the leading indicators calculation, which I found interesting. And they basically do 600 interviews a month. It's a little over 400 for the prelim numbers, and they wrap it up by the end of the month. People, and they must be able to, track demographics for the people they ask in order to give this thing, more relevance. But it's about 600 different responses, plus or minus. People have to answer 50 questions, so it's pretty damn thorough. And I just wanted to pull up a couple of the charts that over the last 10 years, there is definitely an extreme pessimism, on the various areas that they do track. So doesn't mean that the market's turning tomorrow, but certainly awful bearish. And this last one was just price change expectations. Obviously people think prices, going forward are going to be more volatile than they've been. And then just the last thing I want to offer, and I'll put this in the chat, but there's so many talking heads out there. There's a fellow by the name of Michael Farr. I think he's on CNBC every once in a while. I never have on CNBC, but my son actually is a financial advisor for Fidelity, and he had mentioned this group to me. This guy sends out a comment once a week or on a quarterly basis. Michael Farr, comes in once a week. I just like it because it's straight shooting. It's no BS. I happen to like what he says. So, I'll just put it in the chat box if you have any interest in signing up to hear from somebody else. It just happens to be somebody that I like. So that is all I wanted to touch on today, Josh, but always appreciate everybody joining.
Okay. I think that's all we had. Anyone else got questions, comments before we close up?
I got one last question for you. And it came into mind as Joe was mentioning talking heads. There's been a lot of discussions on a hard landing, soft landing from the Fed. And I went to look to see what is a soft landing? Because, I was having my doubts on whether that was ever going to happen. And I couldn't find anything that was like, what is a soft landing? Do you guys have any idea what you would think? I don't think there's an official version of it anywhere.
No, there's no official.
Agreed.
Yeah, it's nothing official. I think, soft landing is like minor recession and basically what you can equate with it. moderate to mild.
Yeah, I was just wondering if
Mild.
people would think about if the June lows held, if they would consider that a soft landing.
Oh, yeah. Yeah, huge. That would definitely be soft landing.
I would agree.
Yeah. Yeah, no question.
All right, I was just curious. I mean, I think everybody probably has their own definition. I don't know, when they say that, it's like, I wish they would say, well, what do you mean when you say that? But they just don't. They just, well,
Mhm.
can they achieve a soft landing or will it be a hard landing? Well, we don't know, but we certainly don't know if you don't tell us what they are.
Right. Well, I think they just do that on purpose, but yeah.
Yeah, I'm right. I think you're right on that too. Thanks. That's all my last little quick. Thanks.
Yeah, that's a good question. All right.
And
Well,
just,
thank you all.
last
ahead.
thing, Josh, that
Yeah.
not, we obviously got fed today, but not a ton of stuff coming out between now and next week's meeting. We do have, I guess a fair number of housing numbers next Tuesday and Wednesday, but relatively speaking, not a lot of news between now and next Wednesday.
Mhm. Yeah. All right. Well, thank you all. We'll do it again next week. Thank
Have a good
you.
week, everybody. Bye-bye.